Prepare now for what's coming. Most people are going to lose everything. Most of the population is unprepared for what's coming. They think their job or the value of their money will be enough to protect them from this impending disaster. But cash isn't a long-term solution for survival, and most people don't realize how crucial it is to find alternative ways to increase their wealth to support themselves and their families. To put it another way, cash may not be the best choice for an investment. The value of the dollar is being eroded by inflation, uncertain economic conditions, unforeseen political events, economic downturns, wars, financial crashes, poor monetary policies, and other factors that have nothing to do with money affecting its value. No matter how old you are or how young you are, there is always a possibility that something could go wrong at a moment's notice. The key to averting disaster is preparation. But do you know how or what to get ready for? Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we delve into the topic, make sure to hit like, subscribe, and turn on the notification bell to stay up to date on our videos. Without further ado, let's head on to the video. Most individuals believe that cash is secure. But contrary to popular belief, it is the least safe because it simply lacks a certain level of volatility. Back in 1944, we developed a new monetary system, which is the Bretton Woods monetary system. Subsequently, in 1945, we established a new global order, primarily resulting in an American world order and a bull market for stocks. In addition, we are accustomed to a cycle in which anytime there is an economic slowdown, the central bank may induce debt expansion, which increases demand. And this occurs across three phases of the cycle. Typically, it starts with interest rates. When interest rates are reduced, the economy improves. But when interest rates are zero, as they were during the 1932 debt crisis, the economy stagnates. Then, the second kind of monetary policy involves central banks printing money and buying financial assets to add liquidity. As a result of such purchases, bond sellers who receive the cash go out and purchase other financial assets, and the cycle goes on and on. However, the only two instances that such situation occurred were in 2008 to 2009 and 1929 to 1932. Meanwhile, zero interest rates, money printing, and monetization will only get you so far. And then there is what we refer to as Monetary Policy 3, which implies that the money does not reach the population and flow to all necessary places. To put it another way, it is the coordination of fiscal and monetary policy in which the central bank purchases a variety of assets generating liquidity and having the impact of purchasing and monetizing government debt. And this is the late cycle of an expansion that is now driving the markets and economy. For instance, today's market liquidity is being produced by the Federal Reserve and the government, which significantly affects the value of money. But what is the value of money? Where does it go? Cash will not make a good investment. In other words, everything depends on the environment. If you look at the returns of asset classes and only consider cash, isn't it an interesting world when interest rates are zero or negative? And then there's a desire to establish a spread, wherein the short-term rates are lower compared to long-term rates and high liquidity. Since the central bank creates this market, it requires a storehold of wealth, which is evident in all asset classes when we examine the market today. Also, this has significant geopolitical implications because as we go towards a world where the wealth gap and political gap are both prevalent, it will be essential to understand how the distribution of money and bills will affect taxation and other policies. This closely resembles the 1930s wherein there isn't an instant increase in general inflation. It negates deflationary pressures and instead causes gradual currency depreciations. All currencies of the early 1930s declined in value in relation to gold. And generally, we observe the same type of phenomenon occurring today without a general level of inflation. It explores other storeholds of wealth and stock, focusing on certain types of stock which closely resemble 1933. In March 1933, Franklin Roosevelt severed the connection with gold-printed money and made money accessible at precisely the same time the bottom of the stock market occurred. This is identical to what the Federal Reserve and the Treasury did on April 9th. The result is a reflation that spreads to other assets like stocks and so on, and the repercussions of not taking action would be unacceptable. When it comes to the wealth gap and other issues, each person, business, and the government has a certain amount of income, spending, and balance sheet. Meanwhile, defaults and restructurings occur when revenue is inadequate relative to costs and when the balance sheet is insufficient or revenue declines to levels below standard. This is true for the general population and a number of businesses. It has been shown throughout history that when there is a severe economic downturn, ineffective monetary policies are developed, and at the same time, there is a significant wealth disparity, political gaps, and an increased chance of internal strife. Therefore, rising internal dispute over how to distribute the wealth pie is common. The dynamic we are currently witnessing will eventually lead to changes in tax laws and other policies, and the environment for investing in the future will be considerably different from the one in the past. Consider it a zero and very low returning asset environment since the market's liquidity is causing all markets' excess returns to decline and become insignificant compared to the extremely low cash rate. So, negative real returns are bad for cash. The most crucial skill is understanding how to diversify effectively, which means going beyond the conventional 60-40 stock-bond mix, or even the same countries, broadening that diversification to include assets that might seem unusual in your portfolio, such as some gold or inflation index bonds, and thinking about the currency exposure and security as dissimilar. Most individuals believe that cash is safe, but it's actually the least safe. Its lack of volatility is just a result of the high cash production, and its real return is negative. It's a tax that costs you money in the form of monetary loss at perhaps 8% annually. As a result, you must diversify as much as possible and think about risk differently. Because of how passive classes are valued, diversification may be done without lowering projected returns. Secondly, if you're going to make tactical bets from them, those tactical bets should have a high degree of diversification on top of that strategic, well-diversified portfolio. Additionally, deviating liquidity is becoming more important than it has ever been as situations shift in unexpected ways. Take, for example, the business that, at first glance, appeared to be successful. The ability to restructure, broaden one's portfolio diversification, and placing a widely diverse set of bets while maintaining a prudent demeanor will be essential in the future. However, despite the fact that we take these traditional asset classes into consideration, we fail to assess the value of money, as well as what will occur when that value is printed and how to diversify. In the same way that they were significant even before 1945, those are the things that need to be taken into consideration. The intriguing part about that is when you consider interest rates at the time, let's suppose the bonds have an expected return of 0. It is evident that their potential to increase or decrease in value is constrained, or that in order to make an impact, one must heavily leverage them, which is undesirable. However, it is evident from history that when central banks choose that road, they will print money and increase its value. And a depression's fundamental problem is essentially a debt liquidity problem. Therefore, reflation will be the option even if interest rates increase, as you're doing right now. Understanding that the nature of diversifying your assets has changed is crucial. Similarly, other assets will help you gain from reflation, since reflation will always happen. And for this reason, especially at times when we're in the midst of a new paradigm, you can observe that all currencies have lost value or even disappeared over time. Hi, we hope you liked watching this video and learned something important. If you enjoyed it, please like, subscribe, and hit the notification bell to stay updated on our videos. Also, make sure to leave your thoughts in the comments section down below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Until next time!